Welcome to this week's Lucia Capital Group Weekly video. If you've got a retirement plan at work, like a 401k, there's a pretty good chance that some of your investment options include something called target date funds. The idea behind a target date fund is fairly simple. You pick a fund with a target year that's closest to the year that you anticipate retiring or needing the money. If you expect to retire in 10 years, you might use a 2030 fund. If you don't expect to retire for 20 years, a 2040 fund might suit your needs better. As you move towards that retirement target date, the fund gradually reduces the risk by changing the investment allocation within the fund. They're kind of a set it and forget it fund with someone else doing all the work for you. Most target date funds are structured as what's called a fund of funds, meaning that they invest in other mutual funds rather than in individual securities. They're designed to create an appropriate allocation of risk and reward based on the date listed on the fund. So a 2030 fund may have a different, presumably less risky, allocation of stocks and bonds than, say, a 2050 fund, because the 2050 fund is about 30 years away, and the 2030, that's just 8 years away. The idea is that the closer you get to that target date, the more conservative the fund's allocation should become. Having said that, though, target date funds are not risk-free, even when the target date has been reached. Funds with identical target dates may, in fact, have completely different investment and risk profiles. And target date funds can lose money if the stocks and bonds owned by the fund drop in value. In fact, Morningstar says that back in 2008, funds with a 2000 to 2010 target date lost an average of 22%. So the date actually means very little. It's simply the date that the fund is basing its risk and reward model on. And that target date also doesn't consider the rest of your portfolio, which may include other stocks and bond investments, thereby throwing your overall allocation off kilter. Another risk is that it can be very difficult to determine what's in the fund and how they perform in any given circumstance. As I mentioned earlier, funds that sound similar may have wildly different investment and risk profiles across various companies. You need to know what the fund's actual allocation of stock, bond, and cash is before you invest. Something else to be aware of is that with most target date funds, once the target date is reached, the portfolio model no longer changes its allocation. This means that if the fund is, say, 80% invested in bonds at the target date, it's going to stay that way until you sell the entire fund. And if interest rates rise, that could put your portfolio at risk. I've said this before. According to the research, a rising glide path of stocks post-retirement, meaning owning more stocks as you age to retirement, may give you better results. And finally, you should consider the fees. The average target date fund had an expense ratio of 52 basis points in 2020, which means that if a fund had a 7% gross return before fees, the net return you'd see after fees is 6.48%. Not terrible, but not great. These fees can really add up over time, and for a target date fund that's a fund of funds, which usually have hidden fees in the investment they hold, they can be even higher. If you're concerned about that, you should check around for the target date funds with lower fees. All of this is not to say that target date funds are bad. They may work really well for people who want something simple and who maybe have a long time horizon before retirement. You just need to consider the risk before you invest in them, because even something that seems simple can turn out to be complicated and expensive. Now, one strategy note here: if you decide to use a target date fund, don't put your ongoing salary deductions into the fund that's based on your retirement date. Use dollar cost averaging to your advantage and put any new ongoing contributions into the fund with the longest target date. Right now may be a good time to go over your 401k allocation with your financial advisor and see if your asset allocation and risk profile are in sync with your goals. Now, we do this every single day at Lucia Capital Group. How can we help you? Just give us a call.